This week's property data offers some real insights for anyone trying to make sense of where Australian housing markets are headed. If you're wondering whether now's a good time to buy, whether investors really are returning, what's happening to auction activity, or how rising construction costs could affect future prices and rental markets, then today's episode of Property Insiders is going to give you the clarity you're looking for. We're going to unpack the numbers that actually matter, interpret the trends behind them, and translate this into some practical takeaways you can use to make smarter decisions. So welcome to this week's episode of Property Insiders, where Australia's leading housing economist, Dr. Andrew Wilson, and I take you behind the headlines to uncover what's really going on. Each week we love to share with you the data, the trends, the insights that the mainstream media often misses. Our aim is to help you make smarter, more confident investment decisions based on facts, not just on fear. So whether you're an investor, a home buyer, or simply property curious, this is where you're going to get the real story. And today we're going to look at a surprising jump in investor lending, what's driving building costs higher, why wages growth's flattening, what's happened to the auction markets, what they're telling us, and most importantly, we'll show you how to put all these pieces together and anticipate what's happening next. Hi, Andrew.
Yeah, good day, Michael. And we've got shall we say, a big week in economic data.
Yes, there is. One of the standout ones was home lending. Now, I know you look at it very carefully at My Housing Market because it's a leading indicator about people's intentions and what's going to happen over the housing market, in the housing markets over the ensuing months. So what happened? What did the ABS data tell us, Andrew?
Well, just firstly, Michael, the ABS have moved, as we know, we say this every quarter, from a monthly home loan data set to a quarterly data set, which is a bit disappointing because, as you said, we look at this data set because it's actually been quite important because it gives us breakdowns in buyer types, which we really don't get from any other reliable source. But and going for the quarterly data set means that we're looking at a longer time frame, which means we're looking back in time a little bit. Particularly, it's confounding because we use monthly data or monthly data sets for our other bits and pieces. But nonetheless, it does still give us that insight into buyer types. So let's have a look at what happened over the latest data, which is the September quarter. We should have obviously anticipated, given the other indicators, particularly house prices having surged over this year, particularly from as a result of those lower interest rates that first occurred in February and then follow up in May, and then another one in August. That this data covers that surge in buyer activity and seller activity from those lower interest rates. So overall, over the quarter, September loans were up by 6.4%. No real surprise there. Owner occupiers up by 2%. I would have thought they'd be a little higher than that. And first home buyers up by 2.3%. The big surge has come, not surprisingly, Michael, from investor, and investor lending was up 13.6% over the quarter, which is a very big number. And as I said, no surprise, given strong capital growth is always a key influence on investor lending, a key motivation for investors. And of course, we've had across the board basically strong prices growth in most of our capital city markets this year. Total home loans, if we look over the full year, up by 5.8%. So, look, a very strong result in terms of investors. No surprise there, given the surge we've had in prices and the fact that we're continuing to see acceleration of prices, and that should encourage even more investors into the market when we get the next data set. When we look at the state breakdowns, New South Wales overtook Victoria for the highest number of quarterly home loans, but Victoria maintained its position as the top destination in terms of growth of home lending over the year. We're still lagging when we look at the longer term trends. We're still lagging the peaks that we saw back in 2021, which was the post-COVID bounce back. But these are still strong numbers when we look at the absolute numbers of loans over the quarter, over 140,000 loans approved, Michael. And we can certainly see the influence of investor lending on the total when we look at the breakdown in terms of the cycles for investors, owner-occupiers and first home buyers. 13.6% investors up over the quarter, Michael. And this year so far, surging 17.6% increase in investor lending, the number of investor loans versus the same period last year. And that really does tell the story, Michael, I think, in terms of the the influence of higher house prices on investor lending, and we would expect that, as I said, to continue. First home buyers, interesting, just up by 0.1% over the year so far compared to the same period last year. But of course, having the government's first home buyer scheme introduced in October, we would certainly expect to see a surge in first home buyer lending when we get the next data set. So, yep, quite strong there in terms of lending. No surprise over the September quarter, given those lower interest rates. And also, as I said, New South Wales now the top destination for home loans, closely followed by Victoria and Queensland. Interestingly, when we see the breakdowns in the growth in annual loans over the year, Victoria up by 10.8%. We know that Melbourne market has been reviving this year, so no surprise there. The reviving Melbourne market leading the charge in terms of the growth of home loans. Interestingly, Queensland just up by 1.1%. Which is a little counterintuitive in a sense, Michael, given just how strong
Yes.
Queensland housing markets are. But I just think it shows you how consistently strong they are. High numbers of lending has been going on for a couple of years there in Queensland. And we're still, obviously, as we report, and we will be reporting in a week or so's time on the November numbers, but house price growth is certainly, and unit price growth is continuing to surge in certainly southeast Queensland and most of the Queensland major local government areas. So, but just 1% growth in loans over the year. But a fairly predictable result there for home lending, Michael. And
Well, the cycle seems to have moved on, Andrew, from Queensland, South Australia and Western Australia, where the annual growth has dropped, to the states that underperformed a little while, New South Wales and definitely Melbourne, which seems to be a point of interest for investors from around Australia. Now, interestingly, you also keep a careful track of home building costs. This factors into the cost of construction of all these new dwellings the government's wanting us to build, from homes to high-rise apartments. Obviously, the cost of high-rise is considerably more when you've got towers and cranes and unions involved. What's happening to the cost of construction, Andrew?
Well, it's interesting, Michael, because we certainly had a surge in the cost of construction following the previous government's home builder policy, which created a surge in demand. We didn't have the building materials or labour to match that surge, so building costs went through the roof. We've seen that ease as that demand eased from that policy, but we've just started to see an uptick in our we run a monthly house building costs index, and just starting to pick up again now, Michael, after looking like easing over the first few months of this year. And that's not good news for a number of reasons. Firstly, of course, it means it's going to be more expensive to build a house. And secondly, this is a part of the basket of goods that works its way into the ABS house index measure. So higher house building costs will put upward pressure on the inflation rate. And of course, that has consequences for interest rate policy. And the other thing, as you mentioned, it also constrains supply, because we know we have these issues with supply in this country, supply of housing. And of course, if it's more expensive to build a house, that is another burden for builders to confront when being in the marketplace. And as I said, it continues to push barriers in front of our trying to match supply and demand in our housing markets. But I think it's when we look at even though we had seen some easing in the rate of growth of building costs, when we look at the actual figures, when we go back to the pre-home builder allowance period, we've actually seen an increase of nearly 60%, Michael, over those past 4 years in house building costs. So it's one thing to say, okay, the rate of growth isn't increasing at the same level, but the actual growth, in absolute terms, is still high. So that equates, of course, to around about 15% per annum increase in the cost to build a house. And again, this has problems for our on the supply side. And when we look at the actual rates of growth, Michael, over September, the month of September, the annual rate of growth was 6.6%. And that's well ahead of where it was a year ago, when we were tracking at around 2.8%. The Reserve Bank has actually said this as well, that it's concerned about higher house building costs now starting to rise again. And I think that even though we're looking at house building costs specifically here, Michael, as you mentioned, it does also have implications for the apartment market as well, because a lot of the building materials and labour that are used in what is a booming approvals market currently for apartments, comes from houses as well. So I
Yes.
think there might be some cost pressures in the apartment market where, that's only going to be exacerbated by what are extraordinary numbers, particularly in Melbourne and Sydney, of building approvals for apartments coming through, and they're approvals. So they're yet to really confront the construction side of the business. That could be, once again, another roadblock to resupplying our housing markets. So not really good news there on a number of fronts, on the inflation and interest rate front, and also on our issues with supply of housing in this country. And of course, at the grassroots level, it's not good news for those thinking of building a house.
Of course not. Now, for those who don't understand, developers need to pre-sell a percentage of their new towers to make the building financially viable before banks lend money. So they've got to already peg the costs before they start construction. They've learned lessons over the last couple of years when a lot of builders went broke. So they're going to factor all these in, meaning the cost of new dwellings is going to be considerably higher than established dwellings. I guess it keeps reminding us that there are opportunities at the moment where you can buy established apartments considerably below the cost of new ones. Now, one of the things that's going to make it more affordable to be able to buy apartments and houses is if interest rate falls. Well, we know that's not going to happen in the near future. And the other would be if our wages go up. So what's lately been happening with wages growth, Andrew?
Oh, the latest wage index data from the ABS, Michael, showed a steady result. The index was up by 0.8% over the September quarter, which was the same. The quarterly increase that was reported over the June quarter. And also annual wages up by 3.4%, which is also the same as recorded over the June quarter. So steady as she goes in a sense for wages growth. However, we've seen and it's a little problematic in a way, because as with a very strong labour market, Michael, and the bounce back from COVID, we did see a surge in wages tracking above 4% there for a period per annum. It did fall back sharply. There were some questions about the methodology here for tracking wages in terms of the wage index, particularly as it related to the outcomes from the national wage case. It's probably had a bigger influence on overall wage index data. It just looks a little wonky to me. Given that we've still got a very strong labour market, high participation rate, the consumer data shows that consumers are out there spending still. So perhaps that 3.4% may be understating just a little bit that wages growth in what is still a strong economy. But nonetheless, it's quite steady. And the Reserve Bank would be quite comfortable with this level of wages growth, given that the other factors, the other economic indicators, such as the labour market, are holding quite strong. So it shows that people don't have the wages to spend, therefore to push up prices, Michael. So some reasonable news there. I think that we're still just above real wages growth if we deduct the inflation rate from the wages growth. So people are in the black in a sense, but I'm not sure they feel that way, Jim.
No, most people would think the cost of living has gone up more than 3.3%, 3.4%.
Yeah.
You're right.
It just seems a bit wonky to me, those numbers. But anyway, it's as I said, it's a better news, it's a reasonable news story on a number of fronts. But as I said, showing that we're having real wages growth, I'm not sure rings a bell with many people.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event. So you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, there's only a few auction weekends left. It's almost the end of the calendar year, and then the auction markets go on holidays, as a lot of us do as well. We know that at this time of the year, there's often more listings. People are just wanting to move on with their lives, finish transactions before the end of the year. How did the auction markets respond over the weekend, Andrew?
Well, fairly predictably, Michael, we've been pointing out that the seasonal factors that occur through the middle of November and into December tend to have lower clearance rates because we're absorbing more properties, high numbers coming into the market. In actual fact, and that's irrespective of where the cycle is. And we've got a very strong cycle at the moment. As we know, we've seen home lending data today, and we know house prices and unit prices are growing strongly generally. So a little bit of an urgency comes into the market at this time of the year, wanting to get transactions concluded before the holiday break. But and we've seen that trend continuing. And the other thing is, Michael, we will start to see an easing generally in the number of properties coming into the market because of that distraction now emerging from the holiday period. Of course, it's only a month to the Christmas Day commencement of the holiday break, and typically you need around about 6 weeks plus to conduct an auction campaign, and people really don't want to be, even the week before Christmas, even though we do get some significant numbers these days in the pre-Christmas week for auctions compared to the old days. But nonetheless, we will continue to see an easing in the number of auctions coming through for seasonal factors. But buyers are still out there, happy to engage in the market. And that's what we saw at the weekend, that slight easing in clearance rates, Michael, and a decline in listings, even though we still have significantly or reasonably high rates, certainly in favour of sellers for clearances of auction properties. And the number of properties being sold under the hammer is still significant given the number of properties that are being offered and the level of clearance rates. So Sydney had 1,400 auctions over the week ending November 22, which was about 150 auctions less than the week before. Clearance rate was lower, was actually the lowest clearance rate since Easter, Michael, for Sydney. But Sydney's had a great run this year. And even when we look at the same week last year, we can see that the clearance rate was still higher than that. And also the number of auctions were higher as well. So still a solid result there for Sydney. Similarly, in Melbourne, auction numbers down by nearly 200 over the week, a 68% clearance rate, just a little bit lower than the week before, 70.5%. But again, Melbourne market tracking well ahead of where it was at the same period last year, where it had a 63.9% clearance rate. Brisbane bucked the trend, even though it had lower auction numbers. Its clearance rate was a little higher and still tracking around about 50%, that Brisbane market, which is certainly a seller's market at that level for Brisbane auction activity. Adelaide, a few more auctions in Adelaide compared to the previous week. Similar auction clearance rate, 78.5%. compared to 80.4% the week before, and well ahead of where it was a year ago, Michael. That Adelaide market really did ease considerably at the end of last year, but it has picked up this year with those lower interest rates. And Adelaide's been the top performer for auction markets over the past month, and continuing with boom time results at that near 80% level. And when we look at Canberra, similar to the other major capitals, with lower numbers of auctions coming into the market, but a higher clearance rate there for Canberra, but around about where it's been for a while. But similar to Adelaide, Canberra and Melbourne is tracking well ahead of where it was a year ago, both in terms of clearance rates and auction numbers. And when we look at the monthly auction clearance rate data, we can see a consistent trend there, that seasonal trend. As November progresses, or as the spring selling season progresses, we do tend to see lower clearance rates with higher volumes of properties coming into the market. Same with Sydney and Melbourne there. Brisbane bucking the trend to some degree, with a clearance rate now tracking higher over November than where it was over October. And Adelaide, fairly consistent, but again, similar to Brisbane, higher in November compared to October. And the Canberra market looks the same as the Sydney and Melbourne markets, just easing over the spring period, but with higher numbers of auctions and still conducting quite healthy numbers of sales. If you're looking for the latest auction clearance rates, of course, Michael, you can get them on my LinkedIn channel every Saturday night around 6 o'clock, the Capital City Snapshot. And of course, Michael produces through his various social networks the full national report on Sundays, and that includes the regional breakdowns for Melbourne and Sydney, and the top 10 sales under the hammer over the week for each of the capitals. So look out for that. It's a good forward indicator as we review every week of what's happening generally in housing markets. Another big week in property, as I guess we could start to say the season's winding down now. We've got some very interesting data coming up this week. We will have the latest inflation data, which will be very important in terms of the where the Reserve Bank heads for its December meeting on interest rates. So we await that as usual with bated breath.
Well, we're going to catch up next week as we always do, but next week we'll have the end of month figures for November from my housing market. So that'll be interesting to see what's happened. But putting together what we've discussed today, if you step back and connect the dots, building costs are rising, and that's going to restrict future supply. Wages growth is steady. Investor lending is accelerating, and that suggests confidence in the markets. Auction markets, they're still remaining resilient, even as they ease a little bit seasonally. So putting all this together, the market has got solid underlying fundamentals and significant forward pressure on prices. We've only got a few more weeks of this year to go, but it seems like we're going to finish the year strongly, and that gives a good indication of how the next year is going to start, Andrew.
Absolutely, Michael. And we've still got a lot of first-home buyers to come into the market.
Yes.
From that government policy. And we are talking tens of thousands of new buyers. And just on the supply side, they're not bringing trade-ins into the marketplace. So, it just continues to unbalance the supply-demand model for our housing markets, which just means higher prices and higher rents.
Well, I guess what we're saying is that 2026 isn't going to be driven by lower interest rates like much of this year, but more by undersupply, population growth, returning investor demand, and of course that resurgence in first home buyers. Sure, the scheme started on the 1st of October, but not everyone was ready to do that. Some were having leases still that are going to not expire. They're in the rental properties for months. Others are still gathering the deposits, living with mum and dad, moving on with their lives. That's an ongoing trend, isn't it, Andrew?
Yes, it is. And it's a very significant driver of our housing markets, Michael. And because there's very strong motivation for first home buyers still to get into the marketplace, not just the cultural drive for home ownership, but also the benefits financially.
And I guess now FOMO, as the prices keep going up, they're wanting to get in before they're even more expensive. Okay, look forward to catching up next week and hearing how the month of November panned out. Thank you, Andrew.
Thanks, Mark.